There we go. Okay, so what we're going to be covering today is the interaction between the business types and what are the benefits of all the different different business entities. Okay, so to start, let's do a little summary. Okay, what's a sole proprietorship? What are some of the benefits of a sole proprietorship? So we've got a sole proprietorship. Whoop. Sole proprietorship, because I can't write. You guys can see that okay?
Right.
Okay. So first benefit, it's instant. I can start it right away.
Yes.
It has
Full control of management.
full control. Okay. I have all of the funds and assets. I don't have to do, it's easy for bookkeeping. Okay. Easy for the bookkeeping. How about decision making? It's just me, so decision making. Pretty simple, right?
Yes.
Okay, but what are now some of the drawbacks?
Unlimited liability.
There you go. The liability is one of the biggest ones. Okay.
You can't sell it.
Can't sell it. Dissolves upon death. Can't sell it. Okay. What are some of the other ones?
Not a separate taxable entity.
There you go. Taxes. It's just basically
Yours.
it's yours. It's your 1040. Now, in some ways, that could be better. You know, it's just under you. It's your 1040. Maybe that's better. Maybe that's worse. I mean, it's kind of how you're doing things. Some people. Remember when I was talking about the bookkeeping could be good or bad? Some people are good at bookkeeping. Maybe for them, a sole proprietorship makes it easier. For others, maybe they're bad at bookkeeping and it makes it really hard. What are some of the other things? What else can you think of?
No double taxation.
No double taxation. Thank you. That was one of the important ones I was looking for. No double tax. Okay. All right. So those are some of the big ones. All right. So now let's look at a partnership. All right. So what we're going to do is let me clear this out here. So let's take a look at a partnership. What are some of the benefits? Again, easy to form.
Yeah, easy to form.
Okay. Bookkeeping's pretty easy.
Mm-hmm.
Okay. Taxes uses a 1065 for taxes, which is really, it kind of just pretty much goes right through to your 1040s in that sense. So, all right. So it's not too hard. What else? What's you can transfer your shares. You can transfer your shares in that sense. You know, you can sell your portion of the partnership. What's the other? What's a really big one that between the two? A sole proprietorship versus a partnership.
Well, it doesn't end at death.
Okay, it doesn't end at death, but here's my important one. What's the key point between a sole proprietorship and partnership?
Well, you've got more people involved.
There you go. Number of people. Sole proprietorship is always one basically.
One.
Okay, partnership.
As I said.
Or more owners.
Yep, more owners. more owners. Okay, so now let's go back to what are some of the disadvantages. You're back to the liability again.
Well, it depends on what, you could make it any kind of entity that you wanted.
In a sense, yeah.
Corp, C Corp, whatever.
Yeah, but if you elect to do that, yeah, exactly. But I mean, in general, we're just going to talk about a general partnership that you just kind of like doing. Sole proprietors between, partnership between friends, kind of thing. But I'm making it the easiest version to start. Okay. Two friends getting together to make widgets.
Right.
So liability starts coming through to them. Now that does mean the profits come right through to them. Now that's a possibility.
That's true. Yeah.
But also that means the loss comes through too. What are some of the other? How about the decision making?
Well, it's between the partners.
Mm-hmm. So the decision.
Whatever percentage ownership has, the largest percentage has the decision making.
So that can fall in either side kind of then, because if you only have, like I said, have that one person's got the 1% for decision making. So that's kind of, it's like, it's an advantage, it's a disadvantage, it depends on how you look at it.
Yeah.
All right. So those are key points. All right. Now you see kind of the difference. It can have more owners. It can have, all right. Now let's start thinking about some others. Let's go to, let's just talk about the big ones. Okay. Let's talk about a C Corp, because everybody kind of knows McDonald's. Okay. What is the one biggest advantage to a C Corp?
It is taxed at a flat rate of 21%. It is a business and a separate entity.
Yeah, it's responsible for its profit and loss. It lives and dies. Okay, not its shareholders. Okay, now we're talking about a C Corp. Remember that too. The liability is exclusively really within that corporation. And that's an important fact.
Yeah.
Okay. Because now, and that's the biggest advantage right there. So the liability issue. Okay. How about decision making? How does that?
Board of directors.
Board of directors. So we have a board of directors. Okay. And how does the board of directors come about? Who decides who the board of directors are?
They're voted.
Who?
By shareholders?
By the shareholders. There you go.
Elected by the shareholders.
Okay. They handle the operation. They handle basically the ownership. And then they direct it to who?
The shareholders.
No, the board of directors then tells, because the board of directors, management. There you go, thank you, that's what I was looking for. Then they tell it to management. Okay, and they handle the day-to-day operations. This is kind of the business focus, if you want to think about it, and the way they're going to go, kind of their mission statement, what they want to produce and that sort of thing. The board of directors has final say, but they get together. They don't actually decide, typically, I should say, they don't decide what plant is going to do what and what, where they're going to build whatever. That's normally decided at this level, the day-to-day operation. It's handled by management. So that's the flow, right? Decision making goes to the shareholders, votes in the board of directors. They handle the overall operating decisions, and then that is then entrusted to how to carry it out, it's kind of like saying, okay, guys, I'm the chairman of the board. I've decided we're going to make widgets. Now what I do is I look at our operations manager and I say, make me some widgets. He then goes, okay, so now I need my production facilities, I need my distribution facilities, things like that, and he handles that as an operation level. The board of directors makes a decision, we're going to make widgets and I want to try to market them to third world countries. Okay. The management then carries it out. You understand the difference between the two? One kind of has the idea. Steve Jobs decides, I think we should make these things. And then over here, we have the team carrying it out. All right?
The implementation. Yeah.
The implementation. Thank you. That was a very good word for it. All right. Do you understand the difference between the two?
Yes.
Okay. So, but the liability still falls here, just within the C Corp. Now, these guys can risk their investment. That's it. They're not liable if the corporation falls. These guys are just the board of directors. I mean, yes, we have had some cases where, now there's a difference here. When I say the liability, how shall I put this? Enron. When Enron went down, what happened to some of the board of directors of Enron? Some of them went to jail, didn't they?
Yeah, some of them were prosecuted.
Mm-hmm. Why were they prosecuted?
It has to do with the transparency laws for business.
It's because they actually intentionally did things which were illegal. Okay. They didn't just, their liability, when I say that they're not liable, they're not liable for any legal actions they direct the company to do. If they direct the company to do something illegal, like Bernie Madoff, okay, the Ponzi scheme, he was falsifying, he was the board of directors and pretty much everything, directing falsified documents and falsified accounting. I'm trying to think, Enron did that, as well as, is it WorldCom? WorldCom had their accounting department falsifying their, and they were, now again, when they were doing it, they were just showing more profits than they were actually doing it by how they shifted their reports. If they reported where it should have been reported, it looked like they had less profits than they did. As a result, because of the way they were reporting it to all of their shareholders, it looked like they were doing better. That was the actions of the board of directors. They intentionally did something to mislead investors. Okay. And that's the difference. They are liable. Now, if they had done it, if they had went out of business and they had done it perfectly legally, they wouldn't have had any liability. Okay. But because they directed people to do unethical and illegal activities, they became liable. All right. Do you understand the difference in that sense? When we say that you're shielded from liability, you're shielded from all legal liability. If you push the company to do something that's considered unethical or illegal, then you are liable. Okay. And that's the difference. So even though it's a C Corp and it's a separate entity, you're still its brain. Okay.
But with any kind of business, if you choose to direct your business to act in illegal manners or deceptive ways like that, you're always going to be liable for those actions.
You're always liable. Correct.
No matter what type of corporation you're in. So.
Correct. Correct. But that's what I was saying is, I know when they say that you're shielding yourself, that's what I was just trying to explain though. When we say that you're shielding yourself from liability, you're shielding yourself from all legal liability. Because even in tax terms, remember what is the strangest kind of tax you have to report? Drug money, prostitution,
Yes.
gun running, all of those things still have to be reported on taxes. Okay, and if you don't report them, you're in violation of tax law. And so I know it sounds weird, but you know, even though there are illegal activities, you still do have to report them.
Do they really
You
report
the
it
income, yeah.
here in US?
Do they really report it? Well, let's put it this way. What's the most famous person who didn't report it? Come on, Garrett, you should know this one.
I do know it. I just Al Capone. There we go.
Thank you. Thank you. Most people don't realize, you know, when you think about Al Capone went to Joliet, man. I know right where he lives outside of Chicago because I know I used to live just a short distance. I used to drive through Joliet. I used to drive by Joliet State Penitentiary because I know right where it's at. Because I know where Joliet is. I've seen the prison walls, you name it, because I know where Al Capone was held. He did not go to prison. No, it's not an island. It's own. It's right, believe it or not, on the south side of Chicago. It's just outside of Chicago. And it has great big walls, lots of razor wire and things on it. But Al Capone was one of the most ruthless killers, and he did gambling, alcohol, prostitution, drugs, you name it. Okay, he was a mob boss, but he did not go to jail for any of those things because they could not prove he did it because he had lots of politicians that he controlled.
Yeah,
But what was the one thing he did? There you go. But the one thing he didn't do is he never paid taxes on those things. And the tax law said, even though they're illegal, you still have to pay taxes on them. They did not put him in prison for any of those things he did. They put him in prison for tax evasion.
Yep.
Okay.
You know, it's pretty weird when you think about that. He did not go to prison for drug running, prostitution, any of that stuff. Okay. He did it. He went to prison for tax evasion.
Got his bookkeeper before.
They got his bookkeeper. There you go. And so remember, when you do something illegal, you still have to report it. So I know when you talk about a C Corp, you think that, okay, it absolves me because the C Corp, when we say it makes an entity, it does 99.9% of the way. That little 1/100th of 1% is you are still the brain. So if you tell it to do something illegal, you are still now liable for that illegal activity. Okay. So, and you can personally then be held liable for it. And that's what happened with these guys. So that's the one thing. Remember, when we talk about the liability, how it shields you from liability, it does up to this point. All right. So what is the worst thing about a C corporation? What's the worst thing about a C Corp? And you guys said it earlier.
It is taxed at the entity level.
There you go. It's taxed twice. Now, what does that mean?
Double taxation.
Double taxation. Now, what does double taxation mean? Anybody got just what's double taxation mean?
Taxed twice on your income.
Mm-hmm.
Yeah.
So what happens is I'm a shareholder. Okay. I own this company. It's a C Corp. So when money comes in, income comes into the company, I pay all my bills at the company level. Whatever's left over, my net profit, I pay income tax on, right?
Yes.
Then whatever's left gets paid to the shareholders, right?
Tax again.
And they then have income tax again, right? So you get taxed here and you get taxed here. Well, that stinks. I don't want to be taxed twice. You know, it's like I don't want to be taxed for at the corporate level and at the other. So that's one of the major drawbacks of a C corp.
But
Okay.
individually, you're not taxed twice. It's the corporation itself has to pay taxes on the income, and then the owners end up paying tax on it.
But
so the income itself is taxed twice.
But do you
You are
remember?
the owner.
Do you guys remember my example where I said we had a corporation and it was $8,000. I think we had $100,000 with 8 people.
Yeah.
And when we looked at it, one way we got $8,000 and the other way we got $12,000 basically. Yep. I think it was something like that. Remember that?
Yep.
And it was simply because we were taxed as a corporation and then we got taxed again. So that's the one disadvantage. We don't want to get taxed twice because it costs us twice as much. You know, I mean, it costs us much more. So as a business owner, I don't want to pay taxes twice. Okay. So that's one of the biggest.
If you have shareholders, isn't the profit distributed to the shareholders?
It is. It is. But remember, they would get more profit if the company is not taxed. Remember, if the company is not taxed and it's only on what they're receiving, then they're not going to get that initial tax from the corporation itself, because if the corporation is taxed, they get taxed here and there's a percentage of it taken out as tax.
Mm-hmm.
Then in addition, whatever's left, you're getting paid to the shareholders. They
Right.
then get taxed again. So instead, if they only got taxed here, they taxed T, not A, they would avoid this and they actually end up making more money.
More dividend.
Which is what they would prefer. I'm a shareholder. I don't want to actually make less money simply because I'm investing in a C corp. So what they do is they want to structure it differently. So now, okay, we know that that's the biggest drawback of a C corp. We know the biggest advantage is the liability protection. Okay, so now let's talk about an S corp. Okay, what's the biggest advantage to it? It's pass through.
Right.
Okay, it avoids that double taxation. In other words, it doesn't pay income tax. Okay, now what are some of the and again, it's almost the exact same as a C corp except for one thing. Remember that liability?
Right.
It's not the same for a S corp.
It's not quite the same for an S corp as it is a C corp, because you are passing some things through to the shareholders and bypassing that taxation level at the corporate level. They are assuming some of the loss risk on the other side. Okay, so some of that liability now falls on the shareholders that did originally fall on the corporation. Okay, and we will get into that into a lot of detail when we analyze that, but it's not as complete. Where we talked about the C corp, the liability is basically its own bubble. Okay, with an S corp, some of it does fall under the shareholders. Okay, they do assume to get that ability to get more money out of their taxes, to avoid that tax and get more money out of their shares, they do assume a little bit of the liability. Okay, so out of the two of them, they're almost the exact same except for that major factor.
How
Where the
much of that
taxation-
liability do they have to assume? How is that determined?
It's really only a matter of if the company takes a loss. And we're going to go into that in detail, because what happens is when a in a C Corp, if there's a loss here, the loss occurs as the shareholders' total risk is just what they've put in. They can only lose up to this point. They can't lose any more.
Mm.
When they are in an S Corp, they can actually lose some more from here. They can be liable for part of the expenses that are left over. Remember, they are, with a C Corp, it's its own entity. Within an S Corp, it's almost its own entity. Okay? You are becoming part of it in a sense. So if there's a problem here, it just dies and you're standing here off to the side. In the S Corps, look at it this way. The S Corp's dying, you're going to get a little sick. Okay? You're going to assume a little bit of that.
Now, with
All
the
right.
S Corp, there's a limit on shareholders too, isn't there? I thought they could only have like 100 shareholders.
100 shareholders.
Whereas a C Corp, you can have.
And that you can have unlimited.
Stock shares you have essentially. So.
Correct. And that is actually one other major difference. But again, you're talking about the difference of how many companies have over 100 shareholders for smaller businesses that aren't, publicly traded and that sort of thing. And here's the advantage. Now, wait. You touched on something. Okay, I am 100 shareholders. How do I get past that? Let's go back to the houses.
Mhm.
Let's go back to the houses, because this is how we're going to go into today's thing. Here is house 1. Remember, here is house 2.
We cannot see.
It's
can
not.
see.
I can-
Okay, it's up there.
Are you talking about a shell corp within the corporation?
Thank you. See what we're going to do to this. Remember, this is what we were doing with our houses. Now, instead of houses, what if we are doing this? What if this S Corp, which is limited to 100 members, remember?
Yeah.
And this S Corp, which is limited to 100 members, and this S Corp, which is limited to 100 members, right? And those 3 are owned by this S Corp. How many members are in this S Corp?
300.
No. How many are in just this one?
100.
100.
How many are in this one?
100.
100.
How many are in this one?
100.
Now, this one owns this one, this one owns this one, and this one owns this one. How many are in this one?
300.
You're wrong. Hang on. 3.
Oh,
3, yeah, because the 100.
There's only 3 members of this S Corp. There's only 3 shareholders of this S Corp.
so what you're saying is radiating out from this S Corp, you could have technically 100
Mm-hmm.
of those corporations attached to it.
Mm-hmm. And so if you take 100 times 100,
You get 1,000.
100,000.
10,000, excuse me.
10,000, yeah.
Is that 100 the shareholders?
this one can
Yeah.
have 100 members.
Yeah.
This one can have 100 members. This one can have 100 members, and this can have 100 of these. And what can this one have? This one could have literally 100 of these.
Holy moly.
So why is it that more of the larger corporations, when you're getting to that level where they have more, at least my understanding and my perspective, I may be wrong on this, choose to do C Corp structure versus the S Corp structure?
Because the C Corp, now remember, what did I say is the bad thing about an S Corp versus a C Corp?
Liability.
Liability.
Yeah.
Okay, so now what happens if I have this one as a C Corp instead of an S Corp?
Then you're limiting your liability.
There you go. What happens with all the funds from this guy?
Limited to the C
Limited.
Corp.
Yeah,
Everything just passes through to this guy, right?
right.
Everything just passes through to this guy, right?
Uh-huh.
Everything just passes through to this guy, right?
Yep.
But all the liability just stuck here.
Uh-huh.
Okay, now you're starting to get it, right?
Okay, yeah.
Now, I, over here, as an individual, here's how I do my investments. Here's me, then, right? I have this as anything, an LLC, right? I don't want this as my, because now I'm going to get sued. Bob's going to sue me, right?
Mm-hmm.
Do I want to risk losing these things?
No.
I'll put it under my personal LLC owns my shares of this.
Got it. So,
'Cause-
okay, so how do the stockholders fit into this whole scenario?
The stockholders would be
Yeah.
one of these guys. Okay.
Okay.
One of these guys. They then want everything to pass through to here because they want as few bumps in between.
Right.
They
and they
know-
want the most income.
So everybody knows there's going to be, to protect themselves, there's a couple of things you got to realize. Okay. Now, we know this. We are going to have double taxation somewhere because it does what? Even though we have double tax somewhere, it gives us that shield from liability, right?
Right.
Yeah.
So we know we want this. We want this somewhere. We want our outer shield. So usually right here at the highest level, we have a C Corp.
Got it.
That's our shield. This is our protection from the world right here. We know we're going to get double taxed on this. Okay, but we go, that's what we're paying for that shield. Right?
Right.
Now, everything under that, though, we don't want to be taxed on. So even though that upper shield is a C Corp, everything underneath it will be LLCs, will be S Corps, sole proprietorships, which, probably more LLCs, but
Right.
that sort of thing. You wouldn't, because what happens if I do this? Is this smart? Would I ever want to do that?
A C Corp
think
owning
so.
a C Corp? No.
Exactly. You never want to do that because
They're getting taxed 4
I
times.
got taxed here,
Right.
I got taxed here, and I got taxed on me.
Right.
Bad idea. So you never would do that. But you know you're going to get taxed somewhere. This is where I said you have to understand what are my benefits. So you have to make your list. What are my benefits of everything? C Corp, we know what it is. You've got that big shield right in front of you. Okay? That liability says it is between that corporation and me is this great big shield which says when they sue it, they're suing them. I am not getting hit for anything except for my money I put into it. My cost for doing that is that double taxation. So I want that to occur as rarely as possible, But I want that double shield. I want that shield in place.
So let's say I buy a McDonald's franchise.
Mm-hmm. Okay, let's
So-
use it as an example. Go ahead.
Yeah. So I buy a McDonald's franchise. So it's just a franchise of McDonald's.
Mm-hmm. So to
So I
McDonald's.
make it an S Corp?
Well, here's the thing. Now, McDonald's franchise, remember, there are two entities here
Right.
because McDonald's and you. McDonald's owns the dirt. Remember, they own the dirt,
The real estate.
the real estate. They are selling to you that name, the use of that name. They have a contract. Okay, for you to use that name and its products and services. The name, the products, and the systems.
Right.
They are leasing to you that dirt.
Right.
Okay. And that's what you get when you get the franchise. You pay them that amount to use the name. You pay your $1 million, and you now have the right to say, I'm a McDonald's here. And then you pay them a monthly fee. How do you spell monthly? Monthly fee and costs to continue getting these and to continue renting that, to continue leasing that. And that's what ends up happening. You have your franchise fee allows you to continue to use that name and use their systems, and you then buy their hamburger buns, their hamburgers, their fries, their ketchup, that sort of thing. That's the products you're buying on a regular basis. That's your cost, and you pay them a monthly rent, just like you're renting any other property, for the land. Okay, they're a real estate. They're a landlord. All right. Now that's what you do when you're a franchisee. Now, remember, how you structure this is entirely up to you. What do you want to do? This is your business. Now, remember, number one, you want to have as much shielding between you and anybody who can come after you. Now, here's your customers.
So I want to be a C Corp because it has the most shielding.
Right. Now, think about something. Now, here's the biggest question. Who is the biggest threat to you in this picture right here?
Customer.
Nope. Who is the biggest threat to you?
McDonald's.
Thank you. Remember what McDonald's has? If you violate this contract, do you have anywhere near the pockets that McDonald's has?
Heck no.
You are not going to be able to stand up to them in court. You know, God would have a tough time in court against McDonald's because they have an entire bank of attorneys which will sue you for name violation, contract violation, you name it. All right? You do not want to violate that contract because they can come after you. Now I'm sure they don't want to take it back, but they'll be reasonable. But in the end, they're your biggest threat because they have the means. If Bob here drinks the hot coffee, okay, what does he have to come after you with? Probably not a whole lot. You know, the hope that he gets a good attorney to come after you and sue you for it.
The assets of the corporation, if it's a C Corp or
there
S
you
Corp.
go. So now here's what you have to do is you have to shield yourself. So you would want to have shield number 1, C Corp here. Or you start saying, okay, how much liability do I want to have? You may go, Okay, I'm pretty tough. I'll do it as an S corp. I get most of the shielding, but I don't want to pay that second tax. Depends on how tough you are. Do you want to do this as an S corp? You know, do you want to do this as a C corp? That's the difference. Do you want to do this as an S corp? Some people are like, you know what? I'm pretty tough. I got a lot of stuff behind me. I have a bunch of other businesses. I've got a lot of backing over here. I own several stores, and they are going into whatever I'm doing now. And think about this. Here's the other thing to think about. What is your structure? Remember, this is your asset. You may not want this to be a C corp, because you may want this to be an S corp, because now think about you. Let's look at the bigger picture here. Here is McDonald's. Here is you. Here is your Taco Bell. Here is your Kentucky Fried Chicken. Here is your, whatever, Blind Onion. And
BO.
okay, I didn't realize that thinking about it. But here is your McDonald's right here. Now, wait a minute. You are right here. This to you, now you have to think of where you're looking from. This to you is your asset. So I want as little between me and my money as I can here. So maybe it's worth it to say, okay, these, I want them as an S corp to pass through and not be taxed on it, and I'll put my shielding here at one level. What I'll do is I'll pass these all through as S corps, okay, to this company, which, like I said, this is Restaurant Ryan's Restaurants, which it is then set up as a C corp possibly, which then shields me. See, remember, where does your shield do the best work?
Well,
Because
you as an individual.
there you go. Because you got to think about this. Where are your hubs? Now, this is the important thing when you're making the Garrett spider web. Okay. You have to think about your spider web. See, you have to go, okay, for this McDonald's, your McDonald's franchise, it wants to have a bulletproof shield around it, right? And the Taco Bell wants to have its shield. But you need to have the strongest shield. So what happens is you want to have the pass through here. So you go, okay, I'm going to make an imaginary connection point. These will be the assets of this. And I'll put my shield, and maybe my shield is actually the Ryan Group, which may own, this is Ryan's Restaurant Corp, which is actually turns out as an S Corp then. And the Ryan Group also owns a real estate thing. And it's an S Corp. All right.
You make yourself a C corp.
And you could actually then do the Ryan Group, which is a C Corp, and that's your hub. And what happens is then it looks like this. Here's you in the middle. You have your connection point to the world. Make this your C Corp. Okay? Then from there, you spoke out. And again, we're going, Garrett, I love your Spider-Man thing. These.
The greatest shield is the C Corp.
Is the C Corp. These then are S Corps, which then branch out
Mm,
into additional
S Corp.
S Corps,
Hmm.
which then hold assets, which can even be in their own LLC if they had to. Because this S Corp, this may be your McDonald's, right?
Right.
This is your restaurants. This is your restaurants. This is your real estate. This is your tax service. This is your loans. And
That's why
this is your S Corp here. This is your restaurants.
the
This is
mother corporation is
it
corporate.
is your
Nice C Corp.
holdings.
Yeah.
Mhm.
Okay. And then this here is your McDonald's ones. So this is the McDonald's you hold on Mill Plain. This is your McDonald's, your LLC that you hold on whatever, Salmon Creek or whatever it may be. And these are your Taco Bell ones that you hold here. And this is your ones for your KFC. Now, do you understand the difference?
Yeah.
You want these to pass through as much as possible. You do want them shielded though, because remember this S Corp, Mike sues here.
Yes.
You lose this. If this is not in its own LLC and it's just in this S Corp, what can you lose? All the McDonald's then. See that?
Right.
If they're not in their own corporations, you can lose all of them in that branch.
So that's where the partial liability in an S Corp comes from.
There you go. There you go. So you are passing it through.
Can it
Oh,
ever
what's
get
that?
back to your C Corp? How it can never get back to your C Corp? It would get hit by that other, the next S Corp and then the next.
Honestly, the one way that it could is if this one, if you screw up somehow and this one can get sued for something it did. Now, that's why you have a shell corporation. The shell corporations, that's why you don't want them doing anything. You want them basically to be dead zombies. Okay? You don't want them interacting really with anyone but these guys.
Is that where they get very basic names, like you said, Ryan Group or whatever?
The Ryan Group. Yep. It doesn't
Yeah,
do
it's
anything.
the mother corporation.
Exactly. It becomes you don't want it doing anything because if it interacts with the outside world, it runs the risk of getting hit. Think of this as the internet. Okay? The internet, if I hit this point on the internet, I lose this part. I don't lose the rest. But if I hit this part of the internet, guess what? I lose all that. It spider webs out. Okay? So where you can protect yourself, and that's why you want as much protection here. This is the C Corp, because that protects you. Okay? So you want yourself outside of it, but you to have the greatest control over this. This then, and in each case, you control and are the beneficiary of each of these. Okay, this one controls and is the beneficiary of this. This is the controls and is the beneficiary of this. Okay, so this is of this one. So this is the boss of all of these. This is controls and is the boss of all of these. And so usually the most you can get to is if by chance, for whatever reason, they were able to try to sue you here, the most it could do is typically get this whole branch. Okay, and that's only usually by actions that are done by specifically this group. So these groups, that's why they call it a shell corporation. They want them to do basically nothing. All they do is layers of an onion. It protects what's inside.
Like a clamshell.
A clamshell. There you go. Thank you. That's perfect. Their job is to basically shield what's here. So when you structure this, now remember, like I said, what are the benefits of each one? A C Corp here, now when we were talking, we'd think that, oh, I want to make this a C Corp here to protect it with the strongest thing. But you wouldn't. You want it to have the strongest it can for itself, but you want it to still have all the pass-through stuff so you get the greatest amount of return to you. Somewhere to protect you, which is usually your center hub, you're going to want a C Corp to protect you, because that is your shield from the outside world. That is the strongest point. Okay? And this is what most people don't think about when they start constructing how they don't think about what their actual structure of their business is. This happens down the road after they've gotten sued a couple of times. Then what happens is they buy and sell parts of it. Okay. So, and they buy and sell parts of it to themselves. Because what happens here? I've got this, I've been running this business for a while. I then create this one, which buys this one. I then create this one, which buys this one. I create this one, which buys this one. And now I own this one. And I wouldn't even own this one. Okay, what's the problem with this? If I zoom in here, let's zoom in to here. Let's say this is my C Corp, and here are my 4 branches. And here is me. What am I going to do there? What's important about one branch? That branch.
Do you want to have your personal assets, like your house, your home, your car, and that in a separate entity between the C Corp?
Garrett, I could kiss you. You know what? I could kiss you. Thank you. That was absolutely perfect. Remember that branch. Let's go back to the beginning. This is your business line. Your house is still here. Your car is still here. Your bank account is still here. And these are your personal ones. Okay, so we're going to distinguish it by going like this. These are your personal ones. And this is your business one. You want to put this, even if it's under an LLC, something to put this into. You do not put this under you. This is your LLC that you control. There's going to be a shield between you and here.
Okay.
Okay. For the one reason that if for whatever reason, this is a big pocket. This is what everybody's going to see, and this is what everybody's going to want to sue, right? This is where all of your, remember, everybody sues the dollars.
Right.
So they're going to try to hit, this is like a great big bullseye here. Everybody's going to try to sue that point. Okay, so you have to make sure that this line has a shield in it between you personally, you know, the guy who looks in the mirror, and that business. Now, I know that may sound paranoid, but trust me, lawyers, this is what they get paid for.
Yeah, you wouldn't want that to be a sole proprietorship because that wouldn't have any effect on protection, and so it'd have to be an LLC or a
Even
partnership.
an
You have a
LLC,
partnership set up with your wife or your spouse or family members who are all connected in that LLC sort
that all individually
we-
control
Yeah.
that asset. There you
How
go.
wait, how can you be an LLC to the corporation?
LLC Ryan.
You're you're a stockholder, right, of the corporation?
Stockholders, in the sense here, this owns one share of this corporation. This corporation only has one share for the corporation. This is
Okay.
basically one share owned by LLC Ryan. And who owns LLC Ryan? Ryan me. Because remember, Naomi, this stuff are my personal things. If I don't have that little piece of shield right here, what's at risk if somebody's coming over at me this way? Those guys.
LLC are owned by 2 or more person, right?
No,
No.
LLC can be owned by one person. An LLC is
Okay.
basically basically a sole proprietorship with an EIN number. Okay, it makes it into a business. That's what and remember what I said, what a sole proprietorship is? It's under my social security number.
Yes.
An
And then you will
LLC,
get an EIN.
you get an EIN, and guess what? You've just formed an LLC basically. Well, you do
Ah,
have to file for an LLC,
yeah, I'm
but
not familiar yet. Okay.
we'll get into that because we're going to cover
Yeah.
each one of these
Yeah, that's why I'm
in
confused.
detail. We're going to cover each one of these in detail, but see, what I needed you to understand is how these work together.
Okay, okay.
Sheila, is this pretty clear?
Oh, yeah.
How you can?
But with this being the C Corp here in the middle,
Uh-huh.
all the liability is shielded within the corporation. So even people coming from around other entities, they can't go past the C Corp, right? For liability, unless you as the stockholder, the shareholder of that, do something illegal that
Well,
affects the operation. Otherwise, they can't get to you. But my thought was your personal assets here, you want these in a corporation separate. So if it gets through to you, they still can't touch that.
but what happens here in this picture? Now remember something here. In this picture right here, take this out. What is that? Without me moving the whole screen. What is this to you?
Well, that is your all your assets basically. I mean, your
Thank you. In these terms, if somebody gets hurt here and comes after and sues this corporation, it's your asset right now. Okay, yes, it's hard to come after you in this sense. It's really hard to come through this line,
but it is possible. Okay.
but it is possible in this sense.
Okay.
But if you do this, it makes it just about impossible for them to come after these guys.
Okay.
This is like this is the added protection, and it doesn't, guys. Is it worth the whatever? I think it's like $100 to file an LLC or something like that. Is that worth the $100?
Well, yeah.
I mean, honest to God, is that worth $100? Oh yes, I would much rather have them going, hey, you come through that wall first before you ever even look at my house, my cars, my bank accounts, my stock, my personal 401k. You know, no way, bud. You're going to come through this wall before you touch any of those.
Mm.
And what about the reverse? Okay, remember, let's go the other way. Let's take this out. Remember this one here? You're having a dinner party. Okay. and Mike is over here, and you guys are barbecuing, and he sticks his hand in the barbecue or whatever happens, something terrible happens, and he gets hurt. What is your asset at this point when I take this one out? When I look at it this
Everything you
way?
have.
Everything you have. Thank you, Amanda. That was perfect. And what do you own right here?
Your C Corp.
Answer to Mike's prayers.
The answer to Mike's prayers. You know, there you go. Thank you, Garrett. This is the prayer approach to protection. You know. Okay. And that is exactly correct, because we always think about it coming in from this side. Okay. But what happens when somebody hits you from this side? This is one of your assets. All right. This is, in this sense, this is your asset. They are going to sue. Who is the owner of this asset? What is one of his other assets?
So if you get in like a
Yes.
car accident and they come after your house because you didn't have enough coverage,
Yes.
eventually they could get to your C Corp too.
Thank you. That was perfect, Amanda. That was absolutely spot on. You got into a car accident, and for whatever reason, you know, something tragic happened, and they come after you and they go, oh, here's your house, here are your bank accounts, here's your stocks. Oh, look at this. You own how many corporations? Oh, thank you. And what do they do? Because in this case, this is your asset. If this is here, between it, guess what? This is not your asset. You may have a problem with the control of it when they try to take it this way, because they're going to then try to take control here. But this will block them from doing anything with all these other ones.
Mm-hmm.
You're going to have to fight them at this point and prevent them from doing anything at this, but you will have blocked them from this.
Mm-hmm.
And that's the idea. Each one of these are a protection from you. And it's, like I said, it's not just protection from this way. It's protection this way as well. Now, does that make sense to you guys?
Mm-hmm.
Now, do you guys see the difference? Now, when we're talking about how is it structured, each one, C Corp, big shield. S Corp, lesser shield, better pass through. Okay?
Mm-hmm.
LLC, lesser shield, but good control and pass through. Sole proprietorship, great pass through, no shield. Okay? Partnership, little bit of shield, good pass through. Okay? When you start looking at them that way, do you understand a little bit more?
Mm-hmm.
Yeah, I really like that.
And when you're passing it through, you have to understand what you're trying to do. Okay? What do I need to accomplish? And sometimes when you also have to look at it as to how many things do I have? How many businesses do I have? What do I need to protect? And you may need to change it. Here's the important thing that a lot of investors don't do. What will end up happening is they'll get their first couple of investments. And they will put it into, or they don't put it into something, and then later on they put it into one or two things, but they don't ever restructure it. Okay. It may have left them wide open to lawsuits where they could lose an entire branch. And remember, when these are connected, you could lose an entire branch based upon how it's connected. Why, if somebody came after this point, you could end up losing everything that's controlled by it. Oh, Sheila took off. Okay, I know she had her appointment, I know. So, I know that that's one of the things that is not usually understood in business, but that is actually why we have all the different types of business, because we want to stack them up with the best things. Okay, we want to have the pass-through, but we do know one thing that's really important. Somewhere we usually want that C Corp somewhere to shield us. Even though we're going to take the tax hit, we want to shield us from the outside world. You normally won't do it, and when you're first starting out, there's the you normally wouldn't do it out here with a C Corp, because then you would end up with another C Corp here, and you'd get that tax here, and tax here. Okay, you wouldn't want to go with that approach. All right, so you think about it when it gets structured. Usually it's you, a little shield here, then the C Corp. Okay, then that C Corp, which has the shielding power, then handles all the other stuff. And you want the communication from that one to all the little guys. So these will then usually be passed through. Okay? Now I know I just dumped a whole lot of information on you. All right, Amanda, you're at work, right? Are
Nope.
you? Can you give me kind of a rundown back on that one? Kind of what we were talking about in your terms?
I'm sorry. I was not paying attention for just a second. Can you ask that one more time?
Can you give me a recap, kind of what, the advantages of structuring it like we were doing?
Yeah, people can only get so far to your assets. It protects the big things you have and make sure they are kind of blocked in on what they have access to.
Perfect. Garrett, what do you think when you're structuring it? C Corp, we know, has what biggest advantage?
Limits of liability within the corporation.
Shielding power.
Shielding power. Yeah.
Shielding power. It
Strongest
limits what
shield.
goes through. Strongest shield. Okay. We know what has the weakest shield.
Sole proprietorship.
Sole
Sole.
proprietor.
Sole proprietorship. There you go. And then each one has varying levels between that. But each one also has its advantages and disadvantages. How did we get around the 100, like you said, there's only 100 members in an S Corp. How did we get around that?
Stacked S Corps.
S Corp owns an S Corp. No problem. Okay. That's not a problem at all. An S Corp can own an S Corp.
That's at a point where your business life, you've got an awful lot of stuff. So, but
you've got some businesses stacked up upon each other, and they're all called shell corporations. Okay, and their job is to protect what's inside. And what is the function of a shell corporation? What do you do with a shell corporation?
hopefully you don't do much with it because you just
don't
want it
do
to,
anything.
Yeah, you don't want it to take on any liability of its own.
You don't want it to have any liability, so its job is to sit there and protect the others. Protect everything inside of it because you don't want it to become a target. All right. Now, does that sound a little bit, does that make it kind of clear how you can start stacking them? And you get the Spider-Man approach to business? I swear that's going to become a book. You know, it's like the Spider-Man method of business. We got to write that book, Garrett. I like that idea. Okay.
Yep.
Make sense to you guys?
Yes.
Yes.
You know me?
Yes.
We good?
Yes.
Because I know that that's usually a hard concept. And by the way, what you guys just learned is something CPAs have a hard time understanding. So congratulations. That was awesome, guys. What you guys just learned was something that business majors and whatnot have a hard time understanding. And you guys just did it in 2 hours. So I am unbelievably proud of you. And both and all of you were able to explain it back to me, which tells me you guys understood it.
But
Okay.
I still have a little problem, Ryan.
What you got?
Because I can hear you, but the illustration is delayed. What do you think I must do? It's
That is,
a problem with my internet?
yeah, I got to check your system out. I got to find out what computer. We're going to do this anyways.
Yeah.
What I just covered, like I said, is a lot. So we're going to take it's 12:20 right now. I'm going to take about 10 minutes here quick because I got one of those other stupid administrative things. Naomi, do me a favor.
Yes.
On your cell phone, I want you to take a picture of your computer on your cell phone and text it to me
Mm,
because I want to see what your computer system is like.
okay.
Okay, so do that for me and text it to me because I want to see what computer setup you have, and then we'll try to figure out how we fix your problem in the meantime. Okay?
Okay, thank you.
Okay, guys, so let's get back here in about 10 minutes, okay?
Okay.
All right. I will see you in about 10 minutes. This. Okay, so we were covering the actual stacking of businesses within each other and on top of each other. Now, the benefits of doing it are you actually end up with the strengths are magnified by this one has these strengths, but it also passes its weaknesses from one to another. But if you do put them in a chain, you can gain the strengths of multiple different types of companies. You do pass their weaknesses as well, but you do give you the ability to shield yourself past the tax benefits and all on and actually protect them from each other, from outside, from wherever they're being possibly sued by, from loss. If one company is going under, now remember, that's the other thing too. One of the things that we haven't really talked about is when we've been talking about a lawsuit maybe or something like that. But one of the things that does happen is if a business goes under. Sometimes a business is just failing. Okay, for whatever reason, it's not surviving. If you have your businesses structured incorrectly, you can actually lose multiple businesses because of one business going under. Because your vendors or whoever you owe money to, your expenditures, they pass on if you just have them set up as their assets. Is this asset is simply part of you if you have it as a sole proprietorship. So just like lawsuits, when you owe money as a sole proprietorship, it is you that owes the money. If it is your asset, one of the businesses, if that business owes money, you owe the money. Now let's start getting into that a little bit because now you're going to understand we're going to start getting into the actual business accounting. Okay. Now, this is a little bit different than normal accounting. When you guys do your accounting and your bookkeeping, you've normally got your checkbook, your savings account, that sort of thing, maybe a 401k. With businesses, it's a little bit different. For a person, an individual, January 1st to December 31st to December 31st is the tax year. Okay, this is for an individual. For a business, you will make, in a sense, the decision by when you incorporate. Okay. Your tax year will start, well, your business year will start on the day that the company is formed. Now, the sole proprietorship, you can say, Ryan Corp starts today. Well, today is the first day of its life. It's also its first fiscal day. Okay. That means in terms of its finances, today is day one. It will then continue on. Now, there are deadlines which follow. Now, this is the fiscal year, and then there is the calendar year. The fiscal year is what your business runs on monetarily. When you bring it in, it will start the day your company is born and the day your company closes. It will be based on the day that the company officially gets its date of incorporation. In other words, the date that it gets recorded on, and I wish I had one with me. I may show you some. I have some articles. I have some corporate licenses, some past ones that I can show you. I think on Monday I'll see about showing you some that show you officially when it starts. It basically starts at 12:01 a.m. on that date. And what it is when you register it with the state, and it's the Department of Revenue, they will send you your license, which is your license of incorporation. And it's a statement from the Department of Revenue and the Secretary of State who says, officially we are signing you into existence. And it will have your official date and time of birth as it was. And thinking about it, I don't, I'll look for that so I can show you one on Monday. I do have some from some businesses that I have when they've started, and show you officially what some look like. That will be your fiscal day one. The calendar year is usually what your taxes are based on. Okay, we have a fiscal year based on your income when it's coming in, and then the calendar year is usually set by the government, which, as we know, it starts January 1st to the 31st, and it's the same thing that individuals follow. Now, when you do your accounting, you can actually, and there are exceptions, but most of them do end up following the actual path of the calendar year. So your taxes are due, you know, the same date that they would be due. Like if you're a sole proprietorship, your taxes are due April 15th. Or your tax return is due April 15th. Now, there are some exceptions. If you have enough income, or you have a tendency to owe money at the end of a year, let's say that you have income coming in and you have it year after year, you're showing that each year you owe money to the government. The government wants use of the money. Okay, and you are basically preventing it from that use. You are holding on to it until the taxes, you pay them. To prevent that, sometimes they will instruct you that you are required, even as a sole proprietorship, to pay what are called estimated taxes. and they're usually paid quarterly. You pay them based on what you have made in previous years, and it's a calculation of a certain percentage where you will be required to basically pay your taxes in advance, because when you do, what's the one biggest advantage of being a sole proprietorship? Think about it. You don't pay taxes until the end of the year, and you get to take your expenses off. Okay, you get to take all your expenses off out of your income. You get a 1099. That's great. But the thing is, you got your income that comes in. You take your expenses out of that. This is your income that comes in. You take your expenses out of that, and whatever the net is, that's what you pay taxes on. Okay? That's the most simplistic version. The problem is, what ends up happening is, for a lot of people at the end of the year, this amount turns out to be a significant amount of money.
Yes.
Okay? And it happens with real estate agents, it happens with attorneys, it happens with, because you are paid on commission. And what ends up happening is you build up this amount you owe, and for most people, because it's taken out of every paycheck, they don't get hit with this large year-end amount. Okay? Also, throughout that year, when you get a W-2, when you're a regular W-2 employee, it pulls out your withholding out of every paycheck. So the government gets that amount each month as a regular amount to continue its expenses, January, February, March, and then it pays them out, and it has regular expenses on a monthly basis. But for all those people who are sole proprietorships and on 1099, they are not going to literally get that. Let's say I do jobs in January and February. They're not going to get the tax money out of that, the government, literally until possibly April or after April the following year. And so what ends up happening is the government actually does need money to function on. And instead of you getting hit with a $5,000, $8,000, $10,000 bill in April the following year, they look at it and say, you have a tendency to owe money at the end of the year, so we are going to require you to pay what are called estimated taxes. So what ends up happening is they divide the year into quarters, and what they will do, quarters, first quarter, second quarter, third quarter, and fourth quarter. And what they will do is they will require you to take out of whatever your projected amount is, whatever you make, to take a certain percentage out and send that to the IRS. This basically helps you in a sense because it makes it so that you do not have to get hit with that great big bill at the end. And also it means that each quarter the IRS has the income from those people and not just in April the following year. This usually happens when you make a significant amount. Now this is normally people who are making, you know, $50, $60, $100,000 more, you know, a year, and there are certain guidelines. Some people will put it aside and pay them without being asked, which is, then they won't, usually the IRS won't adjust it based upon that. If you've been paying, you're sending in 10% of your stuff each year just to make sure you're safe. Each quarter you'd send 10% of whatever you made. That's a great way to do it. That helps prevent a lot of problems because estimated tax keeps people out of trouble because you've been running your business, you've been, making a profit, and all of a sudden it's April, you've been running it, and you have $3,000 in your account that you're looking at, and all of a sudden it says you owe $14,000. Great. I've got $3,000 in my account. I owe $14,000. Now, you're running a sole proprietorship. Let's talk about the IRS. Let's say you owe $14,000 because you've been running a business out of your house. You have $3,000 in your bank account. You have a car worth about $5,000. You have equity in your house worth about $30,000. Okay. You have a 401k worth, say, $50,000. All right, because you've been putting money into it. You owe $14,000 to the government. You don't know how you're going to pay it. Well, the government's going to look at it going, you've got money. The IRS doesn't look at it as like a debtor where they have to go to actually to court where you require a judge to say, you owe this person money, you are going to now have to be garnished for this amount, and that sort of thing, where you go to actually have a court-ordered holding of your assets. Unfortunately, the IRS does not have to do that. The IRS is considered a monetary entity in itself. It's considered a treasury agent. So when you owe them $14,000, guess what they can do? Anybody have an idea? Anybody know what the neat piece of paper is called?
It's called a lien. You can put a lien on your bank account or your property or whatever.
It's much worse than that. Does anybody know what the paper is called?
Garnishment?
Warrant of distraint. Now that sounds pretty severe because it actually is. A warrant of distraint is actually a legal document that gets sent to you by the IRS. They have the power to do this. They are their own judge, jury, and executioner for that, in that sense. They have the power to seize your assets to pay the debt. They don't actually have to go to court. They're their own court system. Probably not the best thing in the world, but yes, they can do this. They have $3,000, like I said, liquid asset in that account. This is cash in a bank.
Tax man cometh.
Taxman, death and taxes. That $3,000 can be taken by order of the IRS, can be immediately taken. That $5,000 car you have can be immediately seized, taken by the IRS. And by the way, that's only $8,000. Now here's the worst part. As you guys know, because most of you guys do the taxes, but a lot of times in the off season, you guys don't see the penalty letters that come in. Okay, it's usually only during the off season that we see a bunch of the penalty letters. The penalty letters are the ones that are sent to the IRS because of taxes owed, errors that were made, things that weren't paid. In the off season, we get them all the time. And unfortunately, they do come with warrants of distraint. It says literally in it, and I should have brought one. I have got several sitting on my desk at the office. The orders of distraint says this is not a warrant for your arrest. This is basically a warrant for your assets. That you are no longer able to basically sell them, that we are going to come after them if you do not resolve this debt, that if you do not contact us to resolve this debt. And with that $14,000 that you owed in back taxes or in taxes is the penalty structure. Okay. The penalty structure involves the immediate back taxes you owe and the penalties for not having paid it on time, in addition to the interest that you owe because you did not pay it to the government on time, and you have been loaned this amount of money from the government going forward. Now, I know that sounds really strange, but you have just been loaned from the U.S. government $14,000 and you are paying interest on it, is what has happened.
You're paying interest on it from April 15th, so.
April 15th on. And it's not at a nice rate, by the way. Not to mention, each month that it is not paid, there is a penalty for not having paid back taxes. So not only are you paying a monthly interest amount, you are paying a monthly penalty for owing back taxes. So you are paying double jeopardy. And it will add up very quickly. And I do mean very quickly. And the problem is, it depends upon the amount. When it comes to the structure of it, now again, this is kind of outside of, this is more in the Section 3 part, where it's the practices and representation to the IRS, because we're going to be covering that in Part 3, and a lot of what the penalties are. But it can turn that warrant of distraint into a warrant of arrest.
Oh no.
And it is not, it can, again, here's the most famous one, Al Capone. Al Capone did not pay his taxes. They wanted to arrest him for other things, so they arrested him for the tax evasion. He intentionally didn't. You've also heard of the other famous ones who've done it. Willie Nelson didn't pay his taxes, went to jail for a while. Wesley Snipes went to jail for a while because he owed like $4 million in taxes. MC Hammer owed taxes. I can't remember some of the other ones. Anybody had named some of the other ones that were hit like that, who had millions of dollars, who literally who actually went to jail because of it? Can you guys think of any?
I can't think of any other names. So.
Those are some of the most that stick out in my mind. But that's what happens, is those taxes, because again, how is somebody like Willie Nelson paid? What is Willie Nelson? Okay, in a business sense, what is Willie Nelson?
He's a singer.
He's a singer, so that typically would make him what, in a sense? It's probably, in a sense, a sole proprietorship in that sense, right? Unless he has somebody good who can structure his business, whatever, he's a sole proprietorship. So who's responsible for his taxes?
He is.
He is. Now, what would have been better? Let's do this, okay? Think about this. Let's make a person. How would it have been better to avoid this? Okay, so we have our estimated tax. We know we're going to have to pay taxes. Here is you. Okay. You're going to have your annual income is $100 million per year. I don't know, maybe that's and it's commission based. You're an actor. Okay, let's do it that way. Tom Cruise, whatever, he made some movies. Okay. So what ends up happening? How does he get paid? Let's pay him.
Per
Let's say,
contract.
There you go.
Per
So
movie.
let's say that took 3 movies to do. He did 3 movies that summer. So he made 50, 30, and 20. Okay? He made $100 million.
Mhm.
How did that check typically come to him? How could the check have let's say there's 2 different versions. Let's make them up here. Let's say here's the worst and here's the best, or our best. How would be the worst way to get paid those 3 checks? I'm getting my checks in here. What would I want to do? I'm telling the movie theater, I want to get paid.
Mhm.
What's the worst way to get paid that way? Pay me directly.
Cash money.
Right here, the worst way, pay me to my sole proprietorship. So write me 3 checks, one for 50 million, one for 30 million, and one for 20 million.
Mhm.
Okay, so where's all the tax liability fall now? And when does it fall?
Right away.
When does it fall? Remember, this is me. It's a sole proprietorship. When are my taxes? When do I think my taxes are due?
April 15.
There you go. So
Following.
my taxes are due April 15th. Right? So they go into my bank account. I figure, oh, cool. I got $100 million sitting there. I go blow it on a new Ferrari, a couple of other cars, a mansion, some stuff like that. And I blow like 80 million on stuff. I got expenses, like I've been partying, this is like houses and cars. I blow another 15 million on parties and stuff, and I got like $5 million left in my account. This is my houses, my cars, paying my other people off. This is what I got left in my account. April 15th comes along. What ends up happening?
No more than what you got.
He is going to get creamed because he currently has $5 million in there. What's about the tax rate? Let's just go 20%. What is
Yeah.
about what he's going to owe? He's going to owe about 20 million bucks,
Yeah.
right? Let's just guess maybe 20 million bucks on April 15th.
Mm.
So he is going to get his butt handed to him because he's got to go scrounge now $15 million from somewhere, probably sell one of those houses he just bought, and not go to jail. And the paparazzi are going to have a great time with that. Okay. So what should he have done? Number one, he never should have paid himself. He should have probably had him pay an LLC or a C Corp or something along that line, or maybe an S Corp, which then paid his C Corp, right?
Mm.
The S Corp, where each movie, this one was one S Corp, this one was one S Corp, and this one, I set up 3 S Corps.
Yeah.
So this one's protected, this one's protected, and this one's protected. And what I do is I have a bank account that I set up, and I take my 20% from that, my 20% from that, and my 20% from that, and put those into account for taxes, my 20% from each one. And then from the businesses, remember, from the businesses, not from me, I have the businesses buy that house, buy that car, buy those things, pay the people. That makes them expenses. Okay, they're expenses. I have to entertain. I'm an actor. Okay, those are expenses. I have to go do my training for it. I'm an actor. Now, guess what? Those now eat up that other $80 million that's left, right? So
Yes.
what if I actually do have that $80 million in expenses, right? That leaves me with my $20 million, right?
Yes.
Okay, that I use for my partying and whatnot. Now, this was my expenses now. This became expenses. So April 15th comes along. What do I get taxed on, basically?
Nothing.
Remember, oh, well, at the most, I get taxed on 20% of $20 million, which would be what? $4 million?
Yeah. But if you claim expenses against that, you can,
Against that, you would even be lower. Exactly. I was just going broad sense here. So now all of a sudden, I only owe $4 million. And if I can go into this 15 and knock it down, all I've got left is $5 million. What's 20% of $5 million?
1.25.
So $150,000 basically. Okay. I'd consider that a whole lot better than that, right? And when I start getting down to these things, is that a whole lot better than what I did here? And did I get paid any more? Got paid the same thing. Did I lose anything? Did I give up my house and my cars or anything else like that? No, I just classified them differently and put them under the corporations. Okay, I structured it differently. And what did I end up having to pay in taxes? Virtually nothing compared to what I had to pay the other way. I'm the same person. I got the same things. But did I have to pay? Did I have to pay anything else? I mean, honestly, did I have to pay anything else or anything like that?
No.
No. I got my house. It's now for entertaining. It's now whatever. They use it as a movie site once in a while. They shoot movies there, so I rent it out to them. When I'm not there, I say, hey, guess what? Oh, yeah, you really like the view? Go shoot that scene there or whatever on my deck. Guess what? I now just turned the whole thing into a business. It's now for business use. I rent it out. You know, I don't have any expense. I have it all as expenses. I'm the same person. I just got paid for the exact same things under a corporation versus under myself and structured it in different ways. And what happens if by chance then something comes along and somebody says, hey, I'm suing you because I disagreed with the money you got on that movie. Remember what I said? We're going to lock this movie up as one S Corp and this S Corp. And somebody got really upset about this movie here and they're suing you because they think whatever. What is your liability? Just the stuff under that movie.
Yes.
They're not coming after this because they can't. This is in a different company. This is in a different company. This is in a different S Corp. And this is the difference between how many dollars? And we're talking about an actor who made $100 million just by chance. Juggling versus saying, pay me $100 million versus, hey, by the way, pay my business this because we're just going to put it all under that. And, you know, here's how it works. I mean, is there anything wrong with that? Here's the question. Is that legal, what I just said?
Yes.
Do you see any problems with that?
No.
Okay. So does it make sense to do it the other way? Does it make even sense to do it as a sole proprietorship?
The other way.
Yeah. You would never do it as a sole proprietorship. You'd never want to. And when you're paying taxes, why would you ever want to pay $20 million in taxes versus what in taxes? Garrett, how about you? What do you think?
Everybody wants to try and minimize their tax burden.
Mhm.
That's why when you hear people complain about political figures not releasing their tax figures or not paying the same amount as everybody else, they're just smarter than you are, so you can't really blame them. So
Exactly. There you go. And here's the thing: is they talk about, well, he's not releasing his tax returns. Do you know how many tax returns he has? You know,
yeah,
it's like, how many tax returns would you release if you have 15 shell corporations that are basically shielding you from these people? When it comes down to it, what's your
right.
personal 1099 say, or your personal 1040 say?
Have you
I
released that
didn't
one?
make much, you
Yep.
know. You know, I didn't make much money. Doesn't matter who you are. If you're smart, you would never pay taxes.
What's the whole thing? The only things in life that are definite are death and taxes. So
So you want to avoid them as much as possible. Here's rule number 1.
yeah,
Do you want to pay taxes?
nobody wants to, but they have to. So
Yeah. So the more you know, doesn't it save you from these taxes?
yeah,
Okay. So with the businesses, let's look at this. When he did that first movie, when I was saying about these, you know, I said, put this aside.
Mhm.
Let's say this. For the first movie, his business was paid as $50 million. For the IRS, take your 20%, send it in. Guess what? At the end of the year, now that may have been in quarter 2. Okay. You take your 20%, or whatever it may be, whatever you calculate, it may be 10%. I'd probably, on $50 million, I'd be doing much more like 10%. Okay. So you take $5 million here and send it in as an estimated tax. And then the next one, you did your $30 million, let's say was in quarter 3. And in quarter 4, you did your $20 million one. So you did $3 million in here and you did $2 million here. You've paid how much? $10 million to the U.S. government, right?
Yes.
What's your tax return? What's your tax refund going to look like in April for your business? You're probably going to get what, $9 million back because of the write-offs that your corporations have based on your expenses if you did it right. Is it better to make the estimated payments and get it back at the end than
Yes.
to get hit by that?
then you get into interest rates on the money you're giving the government to make interest on instead of you're making interest on it. But
Thank you. That is one of the things that some people start to consider.
when you're talking that much money, $10 million with even 3% interest over a year, that's a substantial amount of money. And if you let the government have it, earn it while they're holding on to it versus while you're holding on to it, that's a hit. So
There you go. That's one thing to consider too. But like I said, I would rather pay the taxes in advance and pay the estimated tax than not pay the quarterly estimated tax and get hit with it at the end. Because the power of the IRS goes way beyond your attorneys. Okay.
But you are not supposed to pay. I mean, there is an option that you will not pay quarterly.
Yes, you can. It depends upon you and what you structure. Now, estimated tax is this. Estimated tax can work one of a number of ways. Okay, and we're going to go into it in detail here because we're going to start getting into the business accounting. We just started to cover, a fiscal year versus a calendar year. Estimated tax can be something you elect to do, and you just, because you're on commission, you're just going to send in an estimated amount of the tax based on you don't want to get hit at the end. You can be ordered to pay an amount out of every commission amount. So that, let's say you have a commission of $10,000 or $20,000, 1%, 5%, 20%, whatever the IRS has deemed you should be paying out of it, will go to the IRS and be your estimated tax based on when you get your commission checks. The other possibility is you have a set amount. Each quarter you're required to pay this amount because they anticipate you're going to have, based on your past performance, let's say you have a regular business that you have regular accounts receivable and accounts payable where it looks like you have a net profit on a regular quarter of, say, $100,000. And so what they say is, we need you to pay $10,000 to us per quarter based on your past performance. And they tell you that it's a set amount of each quarter. Your bill for estimated taxes is this amount.
Mhm.
So it can go either you're electing to do it and you haven't been instructed to do it, or you can be instructed to do it based upon a commission amount if you're like a real estate agent or an attorney that typically runs on commission lawsuits, that sort of thing, or something of that nature where you typically run on a non-specified schedule, or if you have a regular amount that you normally get as a business within a standard time period, they will tell you you need to pay this per quarter. So
I thought corporations in general were required to make quarterly payments to the government for their taxes based off of their quarterly income.
their quarterly income, yes, and
Yeah.
that's usually what it is. That's why I was saying that for a corporation, it's usually a set amount per quarter, and that's why I was saying that based upon their amount of income that it normally is projected, they will have to pay this amount.
But for sole proprietorship,
Yeah, then they make estimated payments like he's talking
They
about.
make estimated payments, right?
okay.
So that's the difference between them. Estimated tax, it kind of, like I said, each structure, a sole proprietorship, the partnerships, the S Corp, C Corp, LLCs, all of them have you can see the general structure of how they handle withholding tax. But
Because
each one,
yeah,
yeah, go ahead, Naomi.
I had a client last tax season, and his tax due is 16,000, and he told me he is not required to pay estimated tax.
He'll normally either get the notice from the IRS. He may not be required to. Some people are exempt from estimated tax. Why? That's often an agreement that they've come up with between them and the IRS. What determines that is usually a negotiation between them and an IRS agent who has decided that they do not have to pay a quarterly amount.
Yeah.
And it's on a case-by-case basis.
Okay.
So,
Because if you file taxes like an individual or your family and you owe more than $1,000 at the end of the year, it's strongly suggested you make estimated payments.
Estimated payments. Correct.
And if you do it a couple of years in a row where you're behind like that, they're going to require
They're
you
going to
start
require you to do
yeah.
it. Because so you can see the progression. You can see the progression. What ends up happening is that if you have owed it at the end of the year for a number of years, especially.
Because the other year he's not an independent contractor. It's the first year that he did it.
It's the first year he did it. So the IRS didn't have a pattern for him.
Yes.
They had just this is his first year where he owes taxes, where they see it, and when it shows up that he is now an independent contractor and viewed as an independent contractor, is he continuing it? Now, it probably won't happen the second year,
Yeah.
But if he owes taxes again at the end of the second year, he may end up start getting a letter the third year, fourth year that says, you have owed $16,000 this year, $12,000, $15,000. You're going to start paying estimated tax. And it does. It happens on a case-by-case basis. So,
Okay.
and that's where you look at it. See, independent contractors, that again, like I said, that's like a sole proprietor. I mean, they are working their own business. They can have it structured, and they can structure it. They're independent contractors. So that's really cool in one sense. You're just getting money from a person, but no taxes or anything are held out, so you can structure it however you want. They can be paying you. They can be paying your business. They can be paying this business, which pays this business. You can have an accounts payable business that you set up, basically, that you do all your business out of. You can have a whole chain of them. So, each one has its own business where it's received. That one transfers its funds to this one. How you set it up is entirely up to you, and how you protect yourself is entirely up to you. And actually, that's what's really cool, because then you don't see taxes so much. And that's also, believe it or not, a way that you can almost shield taxes even from the IRS.
Mhm.
And it's not really, I shouldn't put it in those terms, you're not really shielding it from the IRS. Basically, you're structuring it so that this one is not paying taxes. This one ends up paying taxes, but this one pays this one, which then pays this one. The spiderweb thing. And on its tax return, this one has no income. This one has no income. So even though each month this one brings in what? This could be your pay-in company. This is your independent contractor company that does your framing or whatever. And he could have literally $50,000 a month he brings in to this company, and he's not paying any taxes on it. Well, that's because it doesn't keep the money. It then sends it to this company, which owns it, and then that one goes to this company, which you own, basically. And they get transferred on a regular basis. Now, it almost sounds like a Ponzi scheme, but it's not. You are just shielding and using shell companies to gain benefits as you shift funds between corporations. And one does the services for the other, which handles and owns the services for the other. And that's a matter we'll get into when we start looking at the two biggest things is how they pay each other. And that's actually one of the areas when we start getting into the business accounting that we're going to spend a little bit of time on, because, and that's going to be, I think, Wednesday next week or Friday next week. We're going to be covering one of the major areas is how these things pay each other, because the cash flow between them now, you've seen how they can be structured to try to protect each other. But one of the next major areas is how they pay each other. Because, it's kind of hard to just say, here, have some cash. Well, he owns us. Okay, yeah, well, that's fine. But, you still got to basically allocate where those funds went from this to this so you can show it. So those are based on payments, dividends, receipts, and those we will get into in detail next week, because that adds the next layer to the spider web, okay, which is the cash flow portion of it. And we've looked a lot at the structuring and the protection of it. The cash flow of it and the recording of it are two of the big areas where it really gets kind of confusing. And we're going to spend some time on those especially, because there needs to be a money trail, because if there's not, that's where people really get in trouble. If you don't specify, remember what I was saying about this one, where that estimated taxes paid, where the money came in, you need to specify the money went from here to here. It paid for these things, which were used for these things. And that's what an IRS audit, when something gets audited and you allocate for them, that's what you need to show. You need to show that here is what these funds were, and here is what these funds were for. And sometimes that's where the problems come in, is we see them as you should be able to use it for this, you should be able to use it for this, and we used it for this. And the IRS agents have to either agree with that or disagree with that. And like I said, that's actually all in part 3 of the book, where we start getting into the IRS negotiation kind of thing, the representation portion. All right, but we'll wait for that. You got a whole nother 2 tests between now and then, okay? So don't worry about that section yet. All right. So did you guys get anything out of today? We're gonna call this quits today, because the next section is gonna get big. This is where we actually get into accounting. Okay.
Okay.
So did you guys get anything out of today?
Yeah.
Yeah.
I mean, the structuring, I know that a lot of people have never seen how you can actually structure businesses. And
So,
I know
I have a
that's a little weird. Huh?
I kind of had a question.
Sure.
What prevents you from having an unlimited amount of shell companies? How far can you go? How many shell companies on top of shell companies on top of shell